A few years ago, a lottery winner named Jack Whitaker took home a jackpot worth hundreds of millions of dollars. Overnight, he had more money than most people earn in a lifetime. Within a few years, much of it was gone, not because the amount wasn't large, but because spending expanded just as quickly. Large purchases, constant requests for help, gifts, upgrades, and ongoing commitments grew faster than the structure supporting them. The wealth looked enormous, but the habits behind it were fragile. You don't have to win the lottery to see the same pattern. Many professionals earn solid incomes, get raises, and still feel financially tight. The paycheck grows, but the lifestyle grows with it. A nicer place to live, a new car payment, subscriptions, upgrades that seem small on their own, but permanent together. From the outside, everything looks successful, yet the sense of stability never really shows up. So the issue usually isn't income, it's behavior. The people who quietly build lasting wealth don't rely on one big opportunity. They rely on small, consistent habits that don't look impressive day to day, but compound over time. In this video, I'll walk you through 9 habits that build quiet wealth. Not luck, not shortcuts, just patterns that gradually separate people who look wealthy from people who actually become financially secure. Once you understand them, financial decisions get simpler. Comparisons matter less, and you start building margin instead of pressure. You'll know what to ignore, what actually moves the needle, and how to make steady progress without constant stress. Pay close attention to habit number 9. It's the one most people never think to ask. And once you hear it, the others begin to click into place. Because wealth rarely arrives all at once. It accumulates through ordinary choices, repeated consistently. And the first step isn't earning more. It's defining where you're actually trying to get. So let's begin with the habit most people skip. Defining enough. Most people are running toward a number they've never actually calculated. They just know they want more. More income, more savings, more security. But more isn't a target. It's a direction without an endpoint. That's why someone can sell a business for $2 million and still feel anxious a year later. The money changed, the pressure didn't. Because the finish line was never defined. Here's the uncomfortable reality. If you don't decide what enough looks like, the world will decide for you. And the world always pushes the number higher. Start with something simple. What does your real life cost per year? Mortgage or rent? Food? Insurance? Healthcare? Travel you actually care about, not the fantasy version, your version. For many households, that number is far lower than they assume once they strip out status spending. Now multiply that annual cost by 25. That's a rough benchmark many planners use for sustainable financial independence. If your life costs $80,000 per year, the target isn't some abstract $5 million. It's about $2 million invested wisely. Suddenly, the mountain looks different. And here's what changes when you know your number. Raises stop feeling urgent. Comparisons lose their grip. You're no longer chasing someone else's scoreboard. The tension most people feel about money isn't always about shortage. It's about vagueness. When the target is unclear, every decision feels heavy. Because once you define enough, the next question becomes unavoidable. If your time is limited, why are you still earning in only one way? 2 ways to make money. There are only 2 ways you can earn. You either trade time for money, or you build something that earns without you. Most people live entirely in the first category. You show up. You work 40, sometimes 50 hours a week. You get paid. Maybe you earn $85,000, maybe $150,000. It feels solid, but there's a hard ceiling. There are only 24 hours in a day. Your income is tied to your presence. And here's what quietly happens in your 40s and 50s. Energy dips, responsibilities rise, healthcare costs increase. The ceiling doesn't move, but the pressure underneath it does. The second path looks different. It's slower at first. It requires patience, but it scales. Rental income, dividend-paying funds, a small business that runs without daily oversight. Like even something as simple as consistently investing in broad market index funds. These systems don't clock out. Consider this. Over the past 30 years, the broad stock market has returned roughly 9 to 10% annually on average. Someone investing $1,000 a month consistently could build well over $1 million over a working lifetime. Not because they were brilliant, because the system worked while they slept. That's the difference. Labor stops when you stop. Systems continue. And the goal isn't to quit your job tomorrow. It's to gradually shift the balance. To let a small percentage of your income start working independently. Over time, that percentage grows, quietly. But once you understand this, Another question becomes sharper. If systems matter more than appearances, why do so many people still spend like visibility equals security? Appearance versus reality of wealth. Drive through any upper middle class neighborhood, and you'll see the signals. New SUVs in the driveway, renovated kitchens, outdoor lighting installed by professionals. From the street, it looks like financial security, but a $900,000 house at today's mortgage rates can mean a $5,500 monthly payment before taxes and insurance. Add two financed vehicles at $700 each, private school tuition, subscriptions that quietly stack up. The margin shrinks fast. Income can be high and still feel tight. This is the quiet gap between looking wealthy and being wealthy. One is visible, the other is structural. Real wealth doesn't announce itself. It shows up as optionality, the ability to handle a layoff without panic, the ability to say no to a bad opportunity, the ability to help a family member without borrowing. There's a simple filter that changes decisions. Does this purchase generate return, or does it generate attention? An investment property that produces $1,200 a month in rent builds leverage. A luxury upgrade that costs $1,200 a month builds pressure. Both feel similar at the moment of purchase. Years later, they look very different. And here's the subtle part. The appearance of wealth often requires constant maintenance. The reality of wealth requires patience and restraint. One consumes cash flow, the other compounds it. Most people don't consciously choose the visible path. They drift into it. Culture is loud. Status is immediate. Ownership that produces return is quiet and slow, which makes the next principle uncomfortable, because even if you choose assets over appearances, one mistake can still undo years of progress. And that mistake usually starts with excitement. Choosing boring consistency. Excitement is expensive. Every year there's a new can't-miss opportunity. Crypto cycles, AI stocks, short-term trading strategies, promising double-digit gains in months. And for a while, some of them work. That's what makes them dangerous. Here's the quieter truth. Over long periods, the majority of actively managed funds underperform simple broad market index funds, not by a little, by a meaningful margin once fees and taxes are factored in. The difference between earning 10% and earning 7% annually over 25 years isn't small. It can mean hundreds of thousands of dollars. Consistency beats brilliance. Someone investing $1,500 a month into a low-cost diversified fund and doing nothing else may not feel sophisticated. There's no story to tell at dinner, no dramatic screenshots, just automatic contributions, reinvested dividends, and time. But that's the point. Boring removes emotion. No panic during downturns, no overconfidence during rallies, just steady participation. And here's the part most people miss. The biggest risk isn't picking the wrong asset. It's abandoning a sound strategy because it feels slow. The market doesn't reward impatience. It rewards endurance. We tend to overestimate what can happen in 1 year and underestimate what can happen in 20. That gap destroys more portfolios than bad luck ever does. Quiet wealth builders don't chase headlines. They build systems they can stick with even when the news cycle gets loud. Because the real question isn't what's the highest return. It's what strategy can I follow for decades without quitting? And even that discipline can fall apart if there's no protection underneath it. Protecting the foundation. A solid portfolio can collapse for one simple reason: no buffer. It doesn't matter how well you invest if a single emergency forces you to liquidate at the worst time. A medical bill, a sudden layoff, a major home repair. These aren't rare events, they're normal life. The average emergency expense for households can easily run $1,000 to $5,000. A job loss can stretch 6 months or longer. Without cash reserves, the math turns brutal fast. Credit cards fill the gap at 20% interest. Investments get sold during downturns. Stress compounds faster than interest ever could. An emergency fund isn't glamorous. It doesn't earn much. Right now, high-yield savings accounts might pay 4 to 5% in strong-rate environments, sometimes less. That won't make you rich. But that's not the job. Its job is to buy time. 6 months of living expenses sitting quietly in cash changes your behavior. You negotiate differently. You make career decisions from strength instead of fear. You don't panic sell assets during volatility. You don't take the first bad offer that comes along. Here's the subtle shift. With protection underneath you, investing becomes rational instead of emotional. Long-term plans survive short-term shocks. Without it, Even a strong strategy unravels under pressure. The floor comes first, then the walls, then the roof. And once you've built that base, something else becomes possible. You stop reacting to this month's noise and start thinking in terms most people never do. Thinking in decades. Most financial stress comes from a 30-day lens. We check balances weekly. We react to market drops immediately. We measure progress by what changed this quarter. But wealth rarely moves in straight, visible lines month to month. Look at long-term market data. Over single years, returns swing wildly. Double-digit gains, double-digit losses. But over 20 and 30-year stretches, the broader trend has historically been upward. The difference between those two views is perspective. Think about someone who started investing consistently in their early 30s. The first 5 years may have looked underwhelming. Modest growth, occasional pullbacks, nothing dramatic. But by year 15, compounding starts to accelerate. By year 25, the curve changes shape entirely. That acceleration doesn't feel exciting in the beginning. It feels invisible. We're wired for short-term feedback. That's why people abandon plans too early. They expect visible progress before the root system has formed. A decade-based mindset changes behavior. Instead of asking, "What did I earn this year?" you ask, "Am I still following the plan?" Instead of reacting to headlines, you measure consistency. Here's the quiet edge. When you zoom out to 10-year blocks, many financial decisions become obvious. That impulse upgrade, that speculative trade, that unnecessary refinance, they don't look as smart when viewed across 20 years. Time rewards patience, it punishes urgency. And once you start thinking this way, another shift becomes necessary. Because even with a long horizon, nothing compounds if you never create the structure to begin with. Pay yourself first. If money hits your checking account and waits there, it will get spent. Not because you lack discipline, because life expands. Groceries cost more than they did 2 years ago. Insurance premiums creep up. Subscriptions renew quietly. There's always something. That's why structure matters more than motivation. Paying yourself first means the moment income arrives, a portion moves automatically into savings or investments before you touch it, not at the end of the month, at the beginning. Even 10% changes the trajectory. On a $100,000 income, that's $10,000 a year. Invested consistently over 25 years at historical market averages, that alone can grow into several $100,000. Increase it to 15% or 20%, and the numbers become transformative. But here's the key, and it only works if you don't rely on willpower. Automatic transfers, automatic 401k contributions, automatic brokerage deposits. You set it once, and the system runs in the background. You adjust your lifestyle to what remains, not the other way around. Most people reverse this. They spend first, save what's left, and there's rarely anything left. The habit isn't about the amount, it's about priority. You are treating your future self like a bill that must be paid. And once that system is in place, something interesting happens. You start noticing how many expenses aren't actually necessary, how many yes decisions were never intentional in the first place. The discipline of saying no. A surprising amount of financial strain comes from polite agreement. The destination wedding you felt obligated to attend. The $150 group dinner that turned into $220 after drinks. The annual vacation upgrade because everyone else is doing it. None of these destroys your finances alone. Together, they quietly reshape your budget. Social pressure is expensive. Studies on consumer behavior consistently show that spending rises in social environments. We anchor to the group. If peers upgrade homes, cars, schools, lifestyles, it subtly resets our internal baseline. Saying no isn't about being cheap. It's about alignment. When someone with financial clarity declines an expense, they aren't rejecting the experience. They're protecting a longer-term priority. They've done the math privately, like they know what matters. Try something simple. Write down 5 recurring expenses you tolerate more than value, not the essentials, the social ones, the automatic yes decisions. Then ask which 2 you could remove without damaging your real quality of life. Most people are surprised by the answer. And here's the quiet power. Every no frees up capital. That capital, invested consistently, compounds. A few $100s a month redirected into long-term investments over 20 years can mean 6 figures in difference. The world will always offer upgrades. Not all of them are meant for you. And once you start filtering decisions through intention instead of approval, another investment becomes obvious. The one that shapes every other outcome. Investing in the mind. Your earning power is an asset. And unlike a stock or property, it can expand. Most people hesitate to spend $40 on a serious book or $500 on a skills course, yet they'll upgrade a phone for $1,200 without blinking. One depreciates, the other compounds. A mid-career professional who adds one high-value skill, data analysis, negotiation, digital marketing, project leadership, can increase income by thousands per year. Over a decade, that's a six-figure difference. Not from working more hours, from working at a higher level. Learning doesn't need to be dramatic. One substantive book a month is 12 a year. Over 5 years, that's 60 focused inputs reshaping how you think about risk, money, psychology, and systems. The return isn't immediate. It shows up in better decisions, and better decisions multiply. There's also defensive value. Industries change, technology shifts, roles disappear. The people who stay curious adapt faster. They see transitions coming earlier. They're not scrambling when the ground moves. Here's the subtle edge. When your knowledge grows, opportunities look different. Investments make more sense. Business models become clearer. Even conversations change. Wealth builders don't just grow capital, they grow capability. Because in the end, money follows structure, and structure follows thinking, which brings everything full circle. If you improve how you think, define what enough means, build systems, protect your base, stay consistent, and choose intentionally, the results stop being random. They start being directional. Key takeaways. Quiet wealth isn't about intensity, it's about alignment. Most financial stress doesn't come from low income. It comes from undefined targets, reactive decisions, and systems that were never built. When you define what enough actually means for your life, pressure shifts. When you separate labor from assets, your ceiling rises. When you choose boring consistency over excitement, volatility loses its grip. Protection creates stability. Stability creates patience. Patience allows compounding to work. And the through line underneath all of it is intention, automatic saving, selective spending, continuous learning, long-term thinking. None of these is dramatic. That's why they work. If this way of thinking resonates, you're already operating differently. The real question isn't whether you can build quiet wealth. It's whether you're willing to build it slowly enough for it to last.